I'd like to welcome back Adam Lawrence for another in-depth dive into 2021. Now, it's been an interesting year. At the start of the year, we started with some forecasts, and Adam was a very popular contributor to the forecast for 2021. But as there's been so much happening in the first quarter of 2021, over 50% of the population vaccinated, Rishi Sunak pulled a budget out of the hat. We felt it appropriate to get Adam back on to actually modify and tweak those forecasts. So a massive welcome back to Adam Lawrence, one of the founders of Partners in Property and a serial property entrepreneur and mentor on the property boardroom as well with Rod Turner. Now, Adam, it's been a really interesting first quarter. Do you want to sort of give me a brief overview as to where you think we are in this quarter?
Sure thing, yes. So not long after we spoke before, Andrew, I think we had a pretty slow start to the year. We started seeing a few headlines creep out about all prices are retreating and the market's down, and everyone was feeling pretty miserable in the depths of the lockdown in sort of late January, weren't they? And then I've got that mug, Andrew. I like that mug. That's a cracker, that is. I love that. So obviously it was easy to be despondent, but we did kind of say that things would move quickly, and sure enough, as the vaccine started to bite, if you like, then things really did start to move quickly. And where we are today, we've kind of got this gauge between some people are still saying, well, we need to be super cautious. People on the other side are saying we should never have been locked down in the first place and we should be going hell for leather and all the rest of it. And as usual, the sensible people are somewhere in the middle, like I'm sure we are.
Well, we also had the Brexit effect, didn't we? Which was a very big unknown at the time. And we're post-Brexit. And from the looks of it, being post-Brexit, we're actually doing better than Europe on the vaccine program.
Well, we're definitely doing better than Europe on the vaccine side of things. The business side of things is more difficult because all I keep reading is very partisan articles in various newspapers that are either going to make it look like Brexit worked regardless of the facts, or going to make it look like Brexit's failed regardless of the facts. So I'm really struggling to see the real picture at the moment, and I can still see more angry people on either side than there really should be, given that we've come out. But I think you've got to be a bit of a fool to try and defend the EU's approach towards AstraZeneca specifically. It's been a mess. It's been terrible. I voted Remain. I'm quite happy to go on the record and say that, but they're not fulfilling me with. I remember why I never liked the EU in the first place. It was a rounded decision that I felt I'd come to, and they've covered themselves in the least glory they've ever covered themselves with, I think, Andrew, to be honest with you on that front. So, couldn't really argue with that. And I think we've seen as well in the last, just to finish off the sort of intro part, I think we've seen in the last month or so, market pick up a bit. There's certainly been more leads. There's been more things that have been worthwhile transacting on. People have come a little bit out of the deep freeze, and some are willing to transact with a fairly bearish approach and are not looking too closely at what the market's showing them in the background, which of course has been, up, as we spoke about when we did our budget sort of so what next for property investors that we did a few weeks ago.
Now, as far as property cycles and things are concerned, and the annual one, you see, we're coming to this spring blossoming just at a time where half of everybody has been jabbed. So that's a perfect storm, isn't it?
It certainly looks that way, David. Yeah, and there's still been a lot of, I don't think much has been made of this, but there's been a lot of stock that's been held off the market. A lot of the price rises were not so much on we're all so used to looking at the demand side factors, and then normally the supply side is a consistent disappointment, isn't it, really? We don't build enough houses. We haven't done that for years. We're a couple of million behind. We know that, and that tends to be roughly the same. But of course, we lost a lot of housing starts last year because of the pandemic. The planning cycle, the planning process has been elongated by everything that's going on. The decisions are still taking far too long, which is clogging everything up even more. But more importantly, and more considerably, it's the stock that's been held off the market that from the supply side has made a big difference. And that's what was really driving those prices up last year. You know, I personally feel that looking at trying to step back and look at the figures, you know, the supply side was over 50% of the reason for the price increases. And then obviously the stamp holiday has been a factor, and there's actually been some good figures around that, something we've talked about before, Andrew, in as much as I think the stamp tax take has only been about 7 million quid lower than it was in the year to February 2020, sorry. So despite this holiday and this supposed huge giveaway, actually we haven't done too badly on stamp duty take at all. So kind of evidences what we've talked about before in terms of how you actually maximise the taxation rather than just put in a sort of arbitrary figure and just go, yeah, well, we'll just do that, you know.
So that's really interesting. I mean, we've covered a few things there, and I'm trying to look forwards based on where we were 3 months ago and where we think our audience needs to be. So, Adam, what are you changing in your forecast from before? I mean, Rishi's had a cracker of a giveaway budget. We've mentioned stamp duty a number of times. We've also seen a lot of pent-up demand due to things like the stamp duty break, but also the withheld stock. And clearly the Class E, the new permitted developments, and all of the national planning policy framework are about to be announced for the future. So has what you were forecasting last time changed, do you think, much?
Well, I think we talked a fair bit about how I thought it would be a pretty volatile and pretty rocky year, Andrew. And of course, what the budget did do is it kicked out the stamp side for longer than any of us thought that he would, really. So we've really got an extra 6 months in terms of what's investor-friendly, relevant stock. And that takes away that plus the end, you know, furlough not ending on the 30th of April. It's all kicked that can down the road, and it's opened the next quarter and the next couple of quarters really up for some really good growth. And what David said is dead right. We've forgotten that we used to have a seasonal property market, because ever since sort of December 19, when we had a rather important election for the future of, you know, investors' housing property portfolios in the UK. Ever since then, we've kind of forgotten what month it is, and things have, you know, January 2020, we pressed on with a Boris bounce. It was much more buoyant than before. February, obviously, we've forgotten about all this now because of this little, this small novel coronavirus that's been going around. But we kind of lost our months completely. But as David said, we should start to really find a bit of that again. And there's real cause for optimism I think there's a lot of people who've held their, and of course it's really difficult to evidence this stuff, but I think there's a lot of people who've held their stock off the market while the pandemic has sort of taken hold. And it was easy to sort of not put something on in September, October last year, you know, and you started to see the writing on the wall really as soon as the kids went back to school and the students went back to university. So that meant you've got things held up from there. Yes, you've had some transactions sort of pulled forward because of the stamp holiday, but you've also got a lot that haven't come to market. Now, when that seesaw, it's quite a delicate balance, isn't it? Because if we suddenly see a lot of supply, so I think you'd have to see a few things go on there, such as repossessions would have to pick up. And there's no real evidence at the moment, interestingly enough, that really is going to happen at all. I mean, obviously, there'll be some in the pipeline, and they've been put off now for 12 months. And if we go on another 6 months, there'll be, you know, an inevitable number of them. But I think people sometimes forget how few repossessions there are these days, generally anyway. So there might be a portfolio or two in a local area for people that might influence an auction catalogue or a local market, but it's unlikely to influence the national market very much at all, especially with all these figures we've seen about how much money everybody saved and how much households have put in the bank here. And there's lots and lots of people saying, you know, we've got an extra X bit of money that we wouldn't otherwise have. What are they going to spend it on? That's some of them are spending it on slightly higher rents because the supply constriction has very much applied to rentals as it has done to purchases. But what are they going to spend it on? Is it all going to go? Are they all going to splurge it on holidays and then new kitchens and extensions? Or people have already been spending money on their houses because of the lockdown. So, we don't really know, do we? So I think things, the problematic part, the bottom of this curve now has probably been kicked out to about Q1 2022. Will we see further measures? Well, would it surprise any of us if we did? Are we guaranteed to have a nice, easy winter and is this going to go without incident? I don't think so, gents. If I'm honest with you, I don't see that happen. But that's. I don't want to kill the buzz as we're talking things up for a while. But I think Q4 could be interesting, couldn't it?
This supply demand thing is quite interesting, isn't it? Because I had some stuff to sell in central Cambridge, prime real estate, but it didn't get anywhere near the price that I wanted. And what tends to happen in markets like that, or central London, or Oxford, or whatever like that, is just, well, as I did, people take it off market because they don't have to sell. So I tenanted it all out again and everything, and took some money out that way to do the stuff that I needed to do. So there are always kind of alternatives. Now, from my point of view, and I'm not a homeowner, so it's obviously a large chunk of the market is made up of those kind of people. But as an investor, well, that is now going to stay with tenants for a year or two. So that stock has gone for a while.
Mm-hmm. Yeah. I mean, it's interesting we're talking about stock and tenants, and we talked about repossessions. I mean, we've got the repossession of the stock, which might be landlord owned because of the eviction ban, which keeps getting kicked further down the road. And that puts pressure on landlords. And then you've got the additional financial bite of the Section 24, which is now in full impact. And I'm aware a lot of landlords have not done anything to protect themselves from Section 24, small or large. So, I mean, what's your thoughts on the eviction ban and how that's impacting the market, and the fact that it's now 31st May before you can start serving your Section 8s, and we've probably got 18 months worth of backlog in the courts when it gets going?
And we're thinking, there's also, likelihood of eviction ban going on till the end of furlough, for example, if we were going to pick something. That would seem to be, I hate to disappoint anyone listening to this in sort of late March, early April 2021, but that does look like quite a likely outcome to me. And I think one of the impacts that I've definitely seen is more tenanted stuff coming to market.
Yes.
And strangely, not necessarily with particularly difficult tenants in. The fear of the eviction ban is driving some people, and like you said correctly, Andrew, Section 24 as well, and people not being maybe as clued up and getting that next tax return in. Every time the 31st of January has rolled around for the last few years, that ratchet has just tightened a bit more, hasn't it? That was the clever bit of Gideon's policy that we all love so much, that it did, the pain was dripped in like some kind of torture device over 4 years. And, people have still been waking up to that and then think, oh, God, it's going to get worse as well. Well, actually, it's already got worse because you're at the end of the next tax year now. There's all these other reasons to dispose, such as lettings relief. What about the talk about capital gains? In many ways, that might do as much from a speculative point of view as capital gains actually being changed. I'm certain people are disposing. There was a survey that was, I think about 80% of people were going to be spurred into doing something, not necessarily disposing, but taking some action if CGT did change considerably. And how's that going to happen? It's still, it's rumbling under the press, isn't it, at the moment? There's still the headlines out there saying this is happening. They're really giving it some consideration. So whether that's political or whether that's effective, we could debate.
Let's not forget as well. There's some EPC tightening, which is a thing kind of quite close to my heart, which will probably impact your areas kind of a bit more than mine, because a 5 or 10 grand bill on a 100 grand house is very significant, and especially if that property is tenanted and you can't get in to even do it, and you've got £30,000 penalties sort of hanging on over your head. So that's another thing that's been added to the mix this year.
You're dead right, and also the EICRs. Have also, I'm sure, made a difference, because we're certainly seeing tenanted stock come to market that don't know of the EICR thing. I mean, normally people aren't massively clued up on legislation changes, but you try and slip that through during a pandemic, and you can understand why you know, I've got one property, I've got a lot of stuff to worry about at the moment. I don't know if I'm still going to be in my job. I'm on furlough. I've got to remortgage at some point in the near future. The wife's pregnant, God knows what else, you know, you're not worrying about your electrical compliance ultimately. And I've seen a few of those where actually they've forced a few sales because one EICR comes back, the biggest I've seen is 4,200 quid of remedial works in a 2-bed property, which obviously is more than it costs to rewire it, which is insane. But nonetheless, certain landlords of certain constitutions will see that and just go, this isn't for me anymore. Get rid of this through an auction, get it away, you know, don't want to know. And so that's creating, you know, transactions, that's creating friction, that's creating opportunity. And I think these tenanted properties as a rule, due diligence is key like it always is. But actually, there's some really good stuff at the moment that is trading at auction. The problem that you've got, of course, is if you're trying to operate a BRRR model or a variant of, how do you add the value if there's a tenant in situ? Well, you know, you've got some real problems there. But does that mean it's not a good asset to buy if you can afford to park a bit of cash up for a while? No, it doesn't, because you might be buying these. You know what you were saying, David, commensurately, the EPC point is a really, really solid one. And if you've got to spend 10K on a 100 grand house, it's going to hurt and you're not going to get it back necessarily on a valuation. But commensurately, if you've got a house that'd be 110K if it was void and you've got a tenant in there, and inevitably, of course, what normally goes hand in hand with this is the house is underlet as well. If it's underlet as well, the yield is suffering from that. The yield-based investors don't want to know at the auction. The developers don't want to know because they can't get the tenant out at the moment. Well, hold on. This is my specialist situation. It starts to get very narrow and it still stacks up on paper. And guess what? I'm there at the front of the queue going, I'll have a go at that one. I'll have a go. If you're going to give me a 20, 25 grand discount for something that, you know, has got a tenant paying from day one, I can make the figures work on that somehow. Yeah, sure thing.
Yeah, and I think they're going to stack up a lot more, as you know, because the penny always takes a while to drop, doesn't it? So I think, you know, these 100 grand properties, which are not going to be worth more than 100 grand after you've spent 10 on them, will, as you say, in certainly, you know, within sort of 18 months or something, the price of those is going to fall.
Well, the key thing I think to look at with both the EPCs and the EICRs, I mean, the EICRs, there are a lot of electricians who perhaps are milking that a little bit. And if you go for a 25 quid EICR inspection, they're out to hunt for work.
Oh, yeah.
So, you know, if you pay the electrician a fair wage, what you'll find is they'll give you a fair report and they're not hunting for work as much because they've covered the time. But with the EPCs, again, it's that north-south divide. Is it worth doing in the north to the south? But also looking around the inventory types, because Victorian properties typically have very, very poor EPCs. And the cost of bringing them up is quite significant.
Yes. Yes, that's what I've been looking at recently as well, because as an aficionado of the old Victorian thing, it's all right down here, but up there, it means, you know, solar electricity on the roof or something, that's sort of 5 grand and everything. That's a minimum. And I've been reworking all because as the EPC reports come out, they're not very helpful. So I sort of rank them in terms of points and costs and everything and optimize on a spreadsheet that I've set up. And, you know, that's the best way to do it, is to put the old electric solar on the roof. Forget about the draft proofing and the light bulbs and everything, because they don't bring it into the next band, so to hell with that. But you know,
which is perverse, isn't it, David, in itself, because you're not conserving any energy by doing that, which is interesting. But I think you've had a really good point, and I think what I would build on there is it's kind of helpful to us that the EPC isn't very helpful, because for those who can be bothered to build the spreadsheet like you have and plug all that stuff in, you know, they'd be hard enough to understand anyway. You know, but the way they're set out at the moment, it's very, very tough to draw those measures out. And like you say, if you can, then get a fair price on them. We talked about grant schemes, I think, Andrew, when we spoke a while back, and we all know, you know, whatever the grant scheme is, miraculously, that tends to be the price of the works, whatever's required. So, you know, there's a strange coincidence that tends to occur there. So, there'll be more of the same. And that's the government's biggest headache with this, what we've estimated, you know, tens of billions need to go into these properties, tens of billions. This is a grant scheme on on a scale that we've never seen the likes of before in terms of property. And how do they make that grant scheme work without the government just being fleeced for whatever they put forward? It's really, really tough for them. So it's a shame the Green Deal didn't work, because the theory of the Green Deal was solid. But of course, the problem was you couldn't pay back the savings you made because there wasn't an economic case for it. And that's why it didn't work. And it's a real shame, because that was the best way, I think, you should be able to pay for it from future gains. If you can't, well, just like the cladding scenario, the government's really got to step in, haven't they?
As an investor, I'm looking at payback time, and the things that I'd have to do under this new scheme are the things that have a 25-year payback time. The things that have a 2-year payback time don't make any difference, which is insane.
Yeah, absolutely. Now, Adam, you touched on the capital gains tax and perhaps the political ball that's being kicked about in the press, but we discussed that before, and it's a bit contrary to what Rishi's budget is. Do you think there'll be any changes in the autumn budget, or are you thinking more like me, it's probably 3-5 years down the road before that happens, because it will throttle back the economy, it'll throttle back house prices, and it'll throttle back house price growth and all of the industries that feed off the property sector? Well, it is a tough one, CGT, isn't it? Because if we had an announcement that then didn't take place for, similar to what he's done with corporation tax, if he gave a 12-month, 2-year runway, that would give a big excuse for people to crystallise some assets and then redeploy the funds, which is what they would want to do. I've said before, George Osborne's only use, really, in terms of unlocking the pensions, the only really clever and smart thing he did, because all of that latent capital that from HMRC's perspective, from the Treasury's perspective, isn't bringing money in because it's sitting inside a protected wrapper. Oh, hi, get your money out of your protected wrapper and then put it into play. Well, we know the multiplier effect. We know how all that was. That was quite smart. If you could look at CGT arguably in a similar way, Andrew, I think, and it could generate some action that would boost the coffers temporarily. And then, of course, we can raise CGT to the full whack income tax rates. And then in 3 or 4 years' time, presuming the Conservatives get re-elected, then they can say, well, we told you we wouldn't get any more tax if we raise the rates. So then they can bring it back down again. That's been maybe slightly cynical, but I think the taxes that are going to strangle things too early would, for me, really only include corporation tax, which obviously is kicked out for a couple of years and doesn't affect 70% of companies anyway, because they don't make enough profit. And it'll probably be fewer companies because IR35 is going to put a dent in a fair few personal services companies that did make over 50k a year profit. That's going to make a big difference to those. Then, of course, you've got VAT, which is currently playing about with on the downside rather than the upside. And then you've got income tax, national insurance. The rest of it, without being too blasé about it, is window dressing, really, isn't it? Because it's much more political. Now, don't get me wrong, look after the pennies and the pounds, look after themselves. I get that, but that's why they tend to be much more political moves. And, the Conservatives have shown they've got appetite to do very non-conservative things over the past 12 months, haven't they? So I'm not sure CGT is safe, really.
6 years.
Well, yeah.
Now, looking at the market, I mean, our audience, they're from a commercial, residential, or development background. Let's look at how we can give them some direct direction with regards to commercial, residential, and development opportunities or threats. How do you think that's changed over the last quarter, and what will you be doing differently?
Well, I think you'd have to be pretty swift to act on this sort of stuff now. But obviously, you've got your restart grants that are available for spaces that I think the big dichotomy is: have you gone away and licked your wounds, and then are you ready to come back and bounce back with the economy just the way that it's all set up to do and they want you to do, or have you just had enough? Is this maybe early retirement? Is it I can't be bothered to build this from the ground up again? I built something for 15, 20 years, and then I was bereft because the government didn't look after me when they looked after so many other people during the pandemic, and so there's a real you know, that's what you need to make a sale, isn't it, really? There's a seller and a buyer there at a reasonable price. So loads of opportunities. I think leisure is a big one, Andrew. I think we're going to go mad for a bit of that. And I think there are lots and lots of opportunities there. And with your reduced business rates till March 22, it's influenced what we're doing. You know, we're now, instead of chopping a site up and trying to lease it out, we're just saying, well, no, we don't sod that for a game of soldiers. Ultimately, what we're going to do is we're going to trade it ourselves. We've got a great opportunity here at 2/3, 3 months more off our rates, 2/3 off the rates for the rest of the year. And you've got loads and loads of pent-up demand, again, as we've been talking about. So commercial-wise, definitely. Development-wise, I think you're seeing now people trying to get into the bottom of what they perceive to be a bull market. And I think they're correct. So you're seeing a lot of people flip to either a flipping strategy. Because if you held something last year, oh, what a shame, because it got held up by 3, 4, 5, 6 months maybe. But do you know what? Those 3, 4, 5, 6 months probably made you a few quid. So people are now remembering what it's like to develop in a rising market. And I think you're going to see plenty of that going on, because developers aren't stupid. They know when to pile in. And this looks like dirt cheap money, rising market, all the signs there for a rising market, bigger shortage of new builds, restricted PD on space sizes. This stuff just, it feels like fuel to the fire to me, doesn't it? So that covers, I think, some of your commercial and your developer side. And investment-wise, well, everybody wants to get into something that they can put the money into safely, get a bit of returns, and it looks like they're gonna rise over time. And as David said, you know, when you've got assets that do appreciate or have appreciated in value, if you can't sell it at the money that you want, you can always go back to the well, as he was saying that he did with his one, and that's ultimately what puts you in a stronger position. That the inflationary environment that seems nailed on to me at this point favours all of the above, really. I think people have got to be careful. I think where people have been hurt is on the development side, in terms of if people are providing fixed price contracts for developments, that's an issue. That's been an issue for people because materials have gone up 13% or whatever. You know, there's risks to control there on that front, and we've seen, you know, as much risk as anybody would see in 2 decades in 12 months, haven't we?
But black market in plaster finish, haven't we? So, which is insane.
Well, exactly. 25 quid for a bag of plaster or whatever I was hearing. Yeah, unbelievable.
Yeah. Well, the price where it seems to have stabilised post-pandemic, and I bought some today, is 50% more than it was pre-pandemic. So, you know, it's a good price increase. And I'm buying materials on a daily basis.
You mentioned that, Andrew, and I think it's a really interesting one, because I think what COVID has done, and looking at this solely from a business perspective, I think what COVID's done is given people a once-in-a-generation opportunity to reprice stuff, because there's disposable income out there, there's shortage, there's supply issues, reliability of actually getting it. And this is why one of the reasons why Amazon has done so very well. If you get it on Prime, you know damn well you're going to get it the next day. The poor guy might not want to do it 10:30 at night, but you're going to get it the next day. And that certainty has really, really formed a big part of this. And quality brands and certainty have meant that, you know, if you're in business, you're going to look at these things and think, well, do you know what? We haven't put our price up, maybe because of the referendum. We haven't put our price up for nearly 5 years. Well, do you know what? Now we're going to do all of that in one go. And that obviously impacts things significantly.
Yeah, and house price inflation will benefit, obviously, property investors, because they still owe the same amount of money, and suddenly, the thing's worth a lot more, and they can borrow against it and buy more properties. So kind of, you know, maybe we're going to have a few kind of inflationary years, not just months ahead of us in the market now.
I think the thing to watch, David, will be the pace of change, because what we've also seen over the last 12 months is incredible acceleration and deceleration in different directions. So what I find it quite difficult to predict at the moment is the pace at which that inflation will pick up. And of course, you know, you keep half an eye on the price of crude oil, because it tells you a few things. And of course, it's one of the big components in inflation, and it had been on one hell of a bull run. We had a 7% drop the other day, which was of some significance because it stutters. But if the macro commodity style traders that I tend to listen to are all looking at a very bullish outlook for commodities going forward. So, you know, that's inflationary in itself. You've got all there's the bits that we feel we can control in terms of through the fiscal policy and all the rest of it. But then, of course, there's the bits that we can't control. And that's what, if you hark back to the big old inflationary times of the 70s, of course, that's what really set the wild horse off in the first place, was a genuine oil crisis. So all we need now is a war, dare I say, and something, or just general instability in the Middle East. And goodness knows what could happen to the crude price. And OPEC are, of course, there always to just fan those flames accordingly and make some extra profit from it. So there are risks here that are difficult for us to quantify and that we can't necessarily control. But on the inflationary side, as you say, largely speaking, unless we get to that beyond sort of 4.5% level, which would be huge in comparison to where the base rate is, that would be absolutely gigantic. You'd see people taking some really strong action, I think, in terms of having to get into bricks and mortar, because where else can they protect? Property's a hard asset, isn't it? Gold, dare I say, Bitcoin, not really, to be honest. I'm still skeptical. But property ultimately provides a really good, bricks and mortar provides that inflationary hedge for people, and you might see more people taking advantage. So inflation might provide a bit of an upward, direction in terms of all of that.
Yes, very much so.
And the interesting thing is, with bricks and mortar, most people understand housing because they live in one. They hire a plumber to unblock the drain or fit a new bathroom. So it's fairly understandable and simple. And the metrics for the more naive, and I say for the more naive, can be very simple. X in the front door, X going out on costs, mortgage, expenses, therefore profit. But they actually miss out some of the big stuff, the taxation, the regulation, which we've talked about, the EICRs and the EPCs, and the licensing that's coming on a wider basis. So I think, although people might understand it, I think there'll be a lot of people, as often happens, get burnt by making poor decisions, thinking they understand housing, which they might understand a building, but this is a business and it's a market with rules and regulations.
I think that's a really good point, Andre. People are going to need to get more active in order to get those returns that they, 15 years ago would have got in the building society, realistically. And that's quite scary. And people do tend to be a bit over optimistic and a little bit undereducated, really, unfortunately, in getting involved,
Yeah, well, I'd recommend, if you're not already a member of Partners in Property, joining Adam's network, where you can learn about how to invest in property in a safe community. And that's not sort of about selling courses, it's about helping people and a safe, secure network. And it's across the UK, isn't it, Adam?
That's very kind, Andrew. Thank you. I really appreciate that. And I'd reciprocate and say, look, as and when you guys can run the Great Property Meet again, it's extremely friendly environment. I'd recommend that to anyone who's anywhere around Warwickshire or any neighbouring counties to go up. Andrew gets some great speakers, and it's a fantastic and friendly meeting. So absolutely, you couldn't go wrong either way. Whereas, a lot of the meetings are set up as funnels for courses, as you say, and that's not the way that either of us do things. And it is there to really deliver some value to people.
Well, thank you, Adam. That was so kind of you to say. Now, it's been great having a catch up with you. Are there any last pearls of wisdom that you'd like to share with the audience as a takeaway? And then we shall look forward to convening again in 3 months' time, when perhaps the market has changed a little bit more, because it's going to be a fast-moving market this year.
I agree. Yeah, I do very much look forward to that. And I think the one thing I'd say to people is, make your decisions based on fundamentals. Look at what you're dealing with. Be realistic with your figures. It's not a market where you want to sit on the sidelines for too long, but that doesn't mean jump at the first opportunity that you see. Yes, it's hard at the moment, but let's face it, it's always hard. Really. There are no easy markets. People don't deliver deals to me on a tray. I've been trying to get them to do that for at least 10 years, and they still won't do it, but they won't deliver them to you on a silver platter. But ultimately, if you're sensible with your numbers, if you get in based on fundamentals, if you're happy with your payback periods, don't sit and wait for the perfect one to come along either, because this is a great market to get stuck into. And if we do see a bit of a wobble, don't worry. Don't worry. Don't watch the papers and the headlines every day, because there's always something that's down 2% or 4%, or this has happened or that's happened. Absolutely stay informed, but be sanguine and be sensible with it. So that would be my. If that qualifies as a pearl of wisdom, Andrew, that's what I've got.
I think that's really sound advice, Adam. I mean, David, do you have anything you want to share with us today?
Well, yeah, just to say that, we touched upon Bitcoin. Well, to go from 50 grand to 500, it's only going up by a factor of 10. If we had invested over, say, 10 years or whatever the period is, if we'd invested in property at the year 2000 and we were today, that would have gone up by a factor of 9 if we were 3/4 geared. So it's a no-brainer.
Yeah. I think that's a great takeaway piece of advice. Don't necessarily buy your property all cash. Gear it, leverage, just like any other business, and use somebody else's money, the bank, to actually make your money work harder. So if you haven't already, smash that subscribe button, smash that like button, drop Adam a comment, because he loves your comments, and we'll jump on and feedback. Thank you for joining us today, Adam. David, thank you for facilitating this as well. It's been a pleasure as always, and I can't wait to get out of lockdown so we can get together, have a beer, and do some proper catch-up and networking. Until then, Adam, we'll have to stay on a Zoom. But thank you, everybody, and thank you very much, Adam. Lawrence.
Thanks for having me again, Andrew. Absolute pleasure as always. Thank you both very much.
You're welcome. Thank you.